Hello and welcome to the latest in our series of interviews looking under the hood of SFC Capital. SFC is the UK's leading SEIS fund with an EIS follow-on fund alongside. It is also recognised as the UK's most active early stage investor. My name is Ed Pryor and today I'm joined by our founder CEO Stephen Page, our Chief Investment Officer Joseph Zipfel and our Chief Operating Officer Angelika Burawska. Stephen, let's begin with you. You've had a long and successful career as a software entrepreneur. So what made you want to start again on the other side of the fence as an investor?
I think it happened by chance, firstly. So I'd come to pretty much the end of a number of software companies, two very successful ones, and then I branched, then the last couple were not so successful. And so I was wondering what to do back in 2012-ish timeframe. And one of those failed companies was a company called Ortegra, which was providing services to startups. What we found was that they didn't really want services. What they really wanted was money. So that sort of led me to think, well, maybe I do need to get on this angel bandwagon a bit and help invest in one or two of these companies. And in a way it led from there. So back in those days there were very few angel investors actually, and then a massive event happened actually, which was the government announced this new scheme called SEIS, and that was in 2012. And what the hell was that, we thought, you know. And actually it was a very significant event because it opened up the floodgates to investment in startups. And so I think that was what dragged me further in. And so what we started to do was, I set up a company called Startup Funding Club, 2012. Got some friends involved as investors, angels. And we then did a few events at Home House. And Home House being an upmarket club, I'd got to know it.
Focused on investors and startups, isn't it, Home House?
It was pretty much, but it was very much a general, quite wealthy people going. So
Right.
we thought, this is where maybe we can find some angel investors. And at the time, I had no thoughts about a fund. So we started these events. We called it Crocodile Lair after Dragon's Den. So we put those on 2013. And we actually started to get some success. The first event, we had a company that was in HR tech, and they raised some money. And I thought, this is interesting. People actually are looking to invest in these companies now that SEIS has shown its head. So from there, we then did another event and came across a young company. I started to go out and about a bit. I went up to Oxford in particular because I'd been told that's where a lot of very exciting new young startups are. And I was very lucky to meet one of them, which was a company not called Onfido at the time, but became Onfido.
Now this is one of our favourite stories to tell, this one, isn't it?
Onfido became a very good story for us, which maybe I might not go into now because I don't want to take up the whole of this introduction. But Onfido was presented at Crocodile Lair, and we actually raised some money for it. And I'll go into it briefly because we brought them down, put them into our new office. We'd taken this little tiny, well, it wasn't tiny, but little pretty grubby office in King's Cross called Speedy Place. Just 3 people were working for that company at the time. And then we raised some money for them in 2013. And then at the end of 2013, people started to mention, we saw that a fund had come out, and it was the first SEIS fund, and we thought, that's interesting, maybe we should do something like that. And I then had no clue what a fund was, to be honest. I don't think anyone did in those days. But came across a guy who, and a fund manager, and went and spoke to them and partnered up so that they provided all that side of it, the regulatory side. And we came out with our first fund in the first quarter of 2014. It was called Funding Alpha. But what we unfortunately missed was this Onfido company, because they'd already been invested in. Had we had that in the fund, that would have been exciting.
We can still claim that as part of the angel network.
Totally, because I was personally an investor.
Absolutely.
We incubated. I was a director of the company.
Yeah.
And that company went on to exit for a very large sum.
And it's been a long road of progress since then, both for SEIS, which now has around 10,000 investors each year, investing around £200 million per year, but also for SFC. We now have around 120 million assets under management. So coming to you, Joseph, you joined SFC in its infancy.
Yep.
Looking back now, did you envisage what it would become today back then?
I think if you look back 10 years ago, I don't think we had grand plans to, be a 150 million fund manager. Any point, if you look back, the ecosystem back then, was completely different than what it is today. So you had a handful of accelerators, angel networks, and funds really active in that startup bubble. And we became one of them, but that was really, really early. I mean, if you fast forward to today, you have dozens of accelerators, lots of funds, lots of angel networks. But that wasn't the case back then. So it was very much learning as we go. We didn't really know where, the whole SCS and EIS market was going to go. So it was building very much like a startup, trying to find your market, trying to find your customers, trying to find where the demand is, where the gap in the market could be. And we decided to go really quite early, specialize in SCS. So basically the first fundraise of those companies, so what you call pre-seed these days. At the time, those terms did not exist. And, kind of go through the learning curve. It's, you have to go, I strongly believe, to be a good investor, you have to go through entire cycles with those companies, with those investments. So you invest as much as you can in the early days, and you try and learn from that. And you learn from the failures, you learn from the successes, you learn a lot from the Onfidos, but you also learn a lot from those that don't do so well.
Absolutely. And I guess as an SEIS fund, investing at such an early stage, actually getting access to the right deal flow channels is very important, because you've got to find the best talent and innovation out there in its infancy. So Angelika, coming to you, what about the processes that we had back then, but also today, really worked in sourcing those startups and making sure that we're at the forefront of early stage innovation?
Oh, it's a mix of different things, and I think that it has evolved, and we were tweaking and changing the process, and today it's really two main streams. So one, the fact that we are very much present on the UK scene, and not only, London was always the biggest place for startups, but we are really present in the entire UK. We go out there, we make ourselves visible both offline and online. So entrepreneurs know about us, and as we grew, that visibility was growing with us, and allows us to really attract the most talented entrepreneurs. They come to us. But there's the second stream that we also appreciate very much, which is introducers, people who actually understand entrepreneurship, understand business, and they are active in the startup scene as well, and they send entrepreneurs our way. So they introduce those that they know can benefit from our help. And those two things work pretty well. And I think it's about 50% or almost equal between startups that just find us and come to us, and those that are sent our way because someone else thinks that this is the right thing to do. So we have a process in place, obviously. We have screening step to start with. So we need to first see, okay, does it make sense to go deeper? If it does, then we go through a few more steps. It's really pretty complex because there's a lot of things that you need to analyze. It's not quick. And part of it is obviously due diligence and negotiation of terms before actually an investment happens.
And it's definitely a wide kind of network of introducers, isn't it? We've got accelerators in there, venture builders, universities, which I think make up about 35% of our overall portfolio. Before we get too much into the strategy of SFC, I want to pull back very quickly because this is a look back podcast and ask you, Stephen, and actually this is a question for all of you because you've been all here since our founding days. What mistakes you might have made in those early days that you've learned from today or carried with you today?
Oh, plenty of mistakes.
Well, look, reality is in any business you have to make mistakes. If you don't make mistakes, you don't learn. The key is not to make a mistake that is fatal. So I would say that within SFC, which used to be called Startup Funding Club, we made a lot of mistakes, but generally they were small mistakes. You know, at the end of the day, what is a business about? It's about the people. There's no real other ingredient, actually. And I've always believed that. And so what you have to do is make sure that the people who are working in the business are motivated, do things not just for the end of the month salary. They're really there to help build a business. And I'm very proud of this, in fact, with SFC, because that's what we did. And, you know, we're here today with the first two that joined me in SFC, and without them, we would not be where we are today. And subsequently, without some of the other people, you know. So I think we've, generally speaking, done things pretty well. And we've recovered from mistakes we've made. I can't be specific on a major mistake that we made, but I don't think we did.
I think when you invest in startups, you're going to have failures. That's part of the game. So what's important is to learn from those failures. And as Stephen says, it often comes back to people issues. So you become good. It's totally normal to fail. But you have to understand why you failed, why the investment failed. And take those learnings and make sure you put that into a process where you know next time you can identify those red flags, right? So if you look at a startup that, you know, looked quite exciting when we invested, but then ended up failing a couple of years later, okay, what was wrong with the team? And usually it comes back to quite, you know, personal people issues. You know, why was there imbalance between founders? Why did this founder have more shares than the other? You learn to ask those questions quite early on. And that's totally fine. So you make mistakes, but you go through that learning curve and you learn from those mistakes and you become much better at investing. And our due diligence process that Angelika mentioned is actually now, you know, looking at, you know, 50 questions and data points, actually more than that, where we try and look for those red flags. And those red flags, we know them from, you know, all the failures that we've had in the portfolio. And I think that's what makes us so much better now. So
let me reframe it then and reverse the question. Because we know that there are a lot of EIS funds that have dipped their toe into the SEIS world and then backed out again. What is it about SFC that has made us so robust and made us so successful in this area where others have tried and failed?
Hard work. We were willing to put in the hard work, and because SEIS is hard work. It's a volume business. You have to see kiss a lot of frogs before you get the right one, before you get the princess, or whatever it is. And, you know, so we're happy, and we've been able to do that over the years, work hard and go through a lot of volume companies, thousands and thousands that we've seen over the years, to select the best ones.
I would say that we tackled the complexities of SEIS investments. It's not an easy type of investment in many ways, because obviously there are certain rules and expectations, and it is a fantastic scheme, but at the same time it's demanding as well, both from entrepreneurs and from investors, and someone has to manage it. So it's not an easy type of service to provide, but we managed to manage the complexities of this scheme pretty well. We broke down each step and we found a way to make it efficient so we can deal with volumes quickly, efficiently, and correctly. And I think that many people failed or didn't recognize how to work with resources, how to work with those complexities, how to work with this scheme to make it viable.
And I know that a lot of that burden falls on you as the Chief Operating Officer as well. So you've built proprietary platforms to help us with investor management, but also in the investment team, Joseph, you've built this scoring system, which is unique to SFC, that we take everybody through. I wonder if you could just explain very briefly how that works.
Yeah, I mean, basically, like Stephen and Angelika said, what we do is quite high volume. So we do about 100 investments per year, right? So this is not your typical VC type of model. We do a lot of investments. So you have to standardize your process to get there. So we've built a system based on those learnings that I mentioned earlier. So you learn from the failures, you learn from the successes, you try and find, what were the root causes of those events. And we've built a little model, a little matrix, which is basically looking at 30 to 40 data points. So questions that go all the way from people issues such as how long the founders have known each other, how have they split the equity, how do they, manage the salaries within the founders, very practical questions, all the way to more, common, market sizing, IP, etc. So the sort of more classic type of due diligence. And we put that into a model, and that spits out a score. And, that's not necessarily the end all be all of our decision making, but it informs very much ability to make an offer or not to a company. And it actually kind of works for all the type of companies that we look at, because we do everything from consumer all the way to life science and deep tech. But business is business. Certain issues are, the people issues, the financial issues, the way you run a company, whether you're selling, a consumer product or you're developing some new type of drug. There's certain things actually you will have in common, and that's what we focus on. We try and obviously incorporate other elements when you look at different companies, but actually, it often comes down, whether you're going to be successful or not, it often comes down to very similar type of factors, and that's what we try and look for. So our due diligence is actually looking for those potential red flags in a company that we've learned from our experience, having done that for 10 years. And I think, when you focus on something, you do the same thing for 10 years, you learn, you become better at it.
Of course.
And I think that's what's where we are today.
Because it's very difficult when you invest at such an early stage as we do. It's you can't guarantee that a business is going to be successful, but you can get a very good idea of whether it has the chance of being successful based on that early founding team, can't you? Now I want to drag us to the present day. I'm going to ask you all to do something that I know that we at SFC are a little bit uncomfortable with, which is to talk about ourselves. So can you please explain to me where you think SFC now sits in the overall investment ecosystem in the UK?
Who are you asking, Ed?
I'm going to ask you all that question.
Because we've probably got different views, but
Stephen, you
clearly we're the top, the foremost SEIS fund in the UK, and I think we've really specialised in that. We've not gone off and tried to do too many other things. So, I'm a great believer in focus and specialisation, which is what we've done, and that's why we've done so well at SEIS. We obviously also have an EIS fund and follow-on investments, but by focusing, then that's why we're successful. So, you have to keep adding to that bag of products, but generally speaking, not move away from what you're good at.
Yeah, because I think most firms that we compete with, or that we're, are in the same world as us, they've usually used pre-seed or SES type of investments as a stepping stone to something else. So as a stepping stone to raising a later stage fund, a larger fund down the line. We've actually, that's never been our case, actually. We've always said, no, we want to become really good at this. We want to own this market. We want to grow it, and we want to focus on it and build our entire strategy and operations on that, based on that. We want to be the best at selecting companies at that stage, at that kind of pre-revenue, early stage, first fundraise. That's what we're good at, and we're going to focus on that, and we're going to grow that. And actually, I think we've proven that it is possible. You can successfully run a fund at that level. We now have close to 150 million under management. 10 years ago that would have been kind of unthinkable, but we are there now. So, and you achieve that by focusing on something, becoming really good at it, like any startup, really.
Yeah.
And with the recent changes in SEIS, which have of course increased the allowances and the amount that you can invest into a company, it's really made it a mainstream product. You could argue previously that it was only 150,000 going into companies, etc., maybe it wasn't perceived as a mainstream product, but unquestionably now it is, and it's growing. The total number of SE investments that are being made is growing exponentially year on year, and it's only going to continue because it's the key to the UK getting these companies off the ground, and innovation, should be at the core and at the centre of a government strategy. But whether it is or not, that's debatable, but it should be, and that's how you get these companies off the ground.
And that's very true. That was going to be my next question about the role of SEIS and EIS, because obviously it's been foremost in the UK, becoming one of the most globally competitive early stage venture capital environments. I think we're third only to the US and China, and obviously we want to keep growing that. But those recent changes have had a really interesting effect on the investor makeup of the market, where we've seen a new demographic of investors come through for the first time, often led by financial advisors. And this has come at a time where economic challenges mean that we might have lost some of the smaller investors that are in the market that tend to operate on the crowdfunding platforms, but they're certainly being more than made up for by the amount being invested by a new group of ultra-high net worth that are coming into the market for the first time. So do you have any thoughts, Stephen, I think probably mainly for you, on the future of SEIS and its critical importance to the UK?
I do, because I think it is critically important to the UK. And if you go back to before SEIS, very few companies were funded. I think it was literally in the hundreds per annum. Now it's well and truly into the double-digit thousands. So that's down to SEIS. And if the government does anything negatively to SEIS, it will only stop this country. It will probably stop us being number 3 in the world, and London being the number 1 tech city in the world, actually. I think there's a big risk if they do anything. What they need to do, of course, is keep increasing the amounts and the levels that come under SEIS, and make the scheme easier to operate. There's still some clunkiness about it, some resistance to it, but actually it is a phenomenal scheme. It's the only scheme in the world, as far as I know, in any country of the world that does something like this, that enables people, highly paid people, to invest in startups without them getting hands-on or involved day to day in a company. And therefore it's cycling around from the so-called rich to, it's a cyclical economy in that sense. It's taking money from the well-paid people, putting it into the startups who are typically not well-paid. So it's a fantastic cyclical recycling of funds. And the people who invest love it because they're getting most of their money back over time. Initially half, then another, if it fails, another quarter. If it succeeds, they get big wins and they don't pay any tax on that. It's a phenomenal scheme. Any dabbling with it, any changes to it, anything negative to it will affect this country significantly.
Yeah, no, I quite agree. And as you say, we have certainly seen a rapid growth in the number of startups being invested in because of this scheme.
Yes.
And SFC is at the forefront of that. We make about 100 investments per year between 5 SEIS funds each financial year, 2 EIS funds, follow-on funds as well. So, Joseph, is there an example or a couple of examples that you can give of companies that we've invested in over the last few years that best illustrate our identity and focus as a company?
Yeah, so obviously our main success stories in the early days were, the Onfidos and then, Cognizant, 2 companies that reached, $500 million valuations, return in both cases, 100 times return in the case of Onfido, 50 times return in the case of Cognizant. So even in the early days when we didn't really know what we were doing to some extent, we were still hitting those big wins, which actually more than make up for the failures typically. So a good illustration of how, the return dynamics of early stage investing. You don't need that many winners to really do quite well. And more recently, I think we've refocused, like Angelika said, your ability to be a good investor is a lot of that comes down to access. So having relationships with universities, accelerators, etc., that give you the best deals. That make sure the best deals come to you. So in the last few years, we've done a lot more sort of deep tech, life science type of investments coming from top universities in the UK. So we've got companies like Novi, a company that's developing AI for eye disease detection. That's doing very well.
There are a lot to remember, aren't there?
Yeah.
There are a lot to remember. Well, we have invested quite excitingly in one company alongside, founded by Gillian Anderson more recently, haven't we?
I think this is a very good illustration of how our brand has grown to attract this type of founder as well. I'm not saying that Gillian came to us because it was a certain way to come, and our team effort as well to attract this type of founders, but it does illustrate where we are today. But we also have fantastic entrepreneurs from the past, like Ollie's Olives. It's Ollie's now, that started as a really small business that really needed, £50,000 to do something, and now it's growing. Same with Hunter and Gatter, both consumer goods. But we also have software companies like Cognism, which is again an example of a company that did really well. And I think they are now expanding in the US. So the diversity of businesses that we found is extreme, I would say, and that diversification is in the core of what we do because of the high risk that we have to manage. So now, and I have mentioned some of the oldest investments, and we have to remember that early days we haven't made that many. It's only the last few years when that number accelerated. Yeah. So let's meet in 2 years, and probably we'll mention a few more.
We'll be up to 1,000 by then.
Yeah. So some of the investments I'm the most proud of, they're actually investments that are not your typical VC type of investments, which I think is what's so interesting with SEIS and EIS. Actually, the typical VC model is that you only invest in B2B software companies, and we do a lot of that, but we also do. One of our most successful investments is a company called Transcend Packaging, which manufactures sustainable type of packaging. So they
are based in Wales.
Based in South Wales. So very much, manufacturing. So not really your more, in theory, your more scalable model.
They've been a brilliant investment,
and it's been a brilliant investment. They supply brands like McDonald's, Starbucks, all over the world. They've developed incredible products. Paper-based coffee cups and lids and things that are actually changing the world really in many ways, having a huge impact. And that was, typically not a company that would have raised money without SES and EIS, because that doesn't fit your VC model. That doesn't fit your, it's way too early for private equity or things like that. Couldn't be funded by debt initially because there was, nothing at the time. So we invested in that from, a business plan. And then that's done, that first investment's done really, really well. Talking about a company that's got, global contracts with some of the biggest companies in the world. So really proud of that type of investments. There's a few others. So Angelika mentioned some of the consumer product companies. We like doing those once in a while when it's really exceptional. And they've also done really well. So we don't restrict ourselves too much in terms of sectors, because that's the beauty of SES. Yes, you can invest across quite a broad range of companies.
I think we're the only, but I think we are the only fund that will go into anything if it's good. Doesn't matter what the sector is. So the diversity issue that Angelika said is fundamental to our whole business strategy across all regions of the UK, not just London-centric, but because particularly with our relationship with the British Business Bank, we have done hundreds of companies outside London and across all sectors. There's not a sector, I don't think, that we're not in, other than the illegal sectors, which we won't go near. But generally speaking, we're in every sector, and we, with a very diverse group of founders across all denominations.
Yeah, well, we're big believers in diversity, aren't we? And I think in today's world, which is one of perpetual change, it can be useful to spread across different sectors. both to spread risk, but also to capture different growth market opportunities that are emerging all of the time. You mentioned Cognizant, which has been one of our best performing companies, and I just wanted to pull back on that a little bit, because this is an example of a multiple times exit, or a multiple exit company for us. We've seen the emergence more recently of the secondary market in the UK. So I wonder if we might just have a little discussion with that. Joseph, perhaps you could lead on the opportunities for investors through this recent emergence.
Yeah, I think that basically the beauty of being an early investor is that you invest at a stage where valuations are quite reasonable, quite low, quote unquote, although they've come up quite a bit over the years. But basically, when you invest at a pre-seed stage and the company does well and reaches Series A, let's say, Series B, the value of your initial investment can already be up 5 times, 10 times, 20 times, close to 50 times. So you actually get the opportunity to exit your investment in part or in full, if you want, by selling those shares to new incoming investors, because you are realizing quite a healthy multiple at that point. And you don't necessarily need to wait for the IPO, for the trade sale, because that, in the case of Onfido, huge success, but it took 11 years.
11 years.
For the acquisition to happen. So if you have the opportunity to sell shares earlier at a very good multiple, that obviously massively boosts your kind of cash return profile. And we've been really successful at that in the last couple of years particularly. So, basically we've been able to sell shares in some of our best performing companies, keeping some of our holding, but selling, typically, can be a quarter, half, sometimes a bit more, just to return cash back to investors, make sure that, that cash is then reinvested in new companies, realizing returns, proving that this is actually a credible, legitimate asset class. Beyond the initial, tax.
And I'm right in saying that with Cognizant, when we part exited that business, we returned the entire value of the portfolio and then some. Am I right in saying that?
Yeah, many times over actually. So selling 50% of our holding return something like 6-7 times the value of that entire fund. So again, everything else in that portfolio can fail, which it won't, but that fund is doing very well on its own just from one investment. So that's very much the kind of dynamic you get with early stage investments.
And that shows the power of the power law in venture capital, which I think is something we'll explore more in a different episode. But that explains how the fortunes of one investment can carry an entire portfolio, and how you've got to accept risk and accept failure in pursuit of that outsized return and reward. Now, SFC has grown, as I've said a couple of times, into the largest SEIS fund. That also involves having the most investors. And yes, outcomes are the most important thing when it comes to early stage investing and investing through SEIS and EIS funds, but so is the investor experience. So I want to just hold on that for a second and talk about what it is that we do to make sure that we deliver a first-rate investor experience and also a first-rate advisor experience for the growing number of IFAs that we work with. Angelika, I touched on it very briefly before, that you've been at the forefront of building a proprietary platform that gives investors their own bespoke investor profiles. Are you able to explain a little bit about that, and then we might move into other discussions with the other guys about what else we do for investors?
Certainly. Communication is very important, and we understand that. We understand that access to information is very important. Those investors, they don't want to put money and forget. They actually want to know what's happening. And that's why we tried a number of softwares that were out on the market and just doing a little bit of everything for any type of investor, for any type of asset. And it just didn't work because, again, SEIS is a very specific scheme. It's complex. And we try to do what we do very well. So again, that adds to complexity. So there was a need to build something that will work for us, that will help our work behind the scenes, but also will provide investors with access to information and with real-time data. Because anytime a price changes, and obviously it doesn't happen as often as on stock market, but it does, and that change is reflected straight away. investors can log in, they can see what they invested in, what the status of that investment is. We provide every 6 months, we'll provide a long report on what is happening within their portfolios. And every investor might have very different portfolio, and they do have, because many invest a few times in a year. Some investors invest once a year, some investors invest once and that's it. So their portfolios will be very different, they will behave differently, they will have different values, and it's all reflected. So there's no need to wait for a letter that traditional fund managers would issue a letter once a year or twice a year that will look exactly the same as the previous one. It's very dynamic, and I think that it is important today when we want to have access on demand anytime we want. It all happens thanks to the fact that we decided to put time and effort into developing something that is specific to what we do, that is not generic, that is not general, and I think that we did pretty well.
I think we've done very well. I think that convenience factor is one of the most important aspects of SFC and what makes us quite unique in the market. We've got our own proprietary.
Can I just add something?
Of course.
Of course, it's not an advertisement, but I just want to underline that we recognize the need of serving every actor on this scene. So you mentioned independent financial advisors who bear a lot of responsibility, and we work with them in the same way. So they do have access to their clients' data that helps them to discuss how the investments perform. So it is a pretty complex platform in terms of what it does, because we do recognize that it's important to collaborate with people who have interest. So yes, it's not only investors, it's also advisors, but it's also entrepreneurs who have to report to us, who we require to report to us back. So they do that as well in the same place, pretty much.
Because an important point to mention is that every year the money that we invest, we have to raise it every year. We're not a VC fund that has a 10-year commitment from a handful of LPs. We have to raise from hundreds, thousands actually of investors every year the money that we then invest. So right now we're raising more than 50 million per year. We're on track to do 20. And 80% of that money is coming from repeat investors. So people who've put money with us in the previous years. And you only achieve that if you provided a good experience to those investors. And that's what I quite enjoy about working at SFC, is that we're very much a business ourselves, right? So we need to, we understand the startups, therefore, because we're going through that as well. We have clients. We need to provide a good experience to our clients. We need to acquire new clients and keep them. And I think that makes us an interesting investors for companies as well, because we kind of have that same, we share the same problems. We share the same, we understand what you're going through because we are going through as well.
And final thing that I want to add, because it's important to understand how come we can consider ourselves as very solid business. We are not going anywhere. And some people, when we present what we do and we explore opportunities of collaboration, they are surprised that we deal with such big volumes. And again, that's because we are tech-enabled. We are a company that embraced the modernity and necessity to use technology in our favor. And that's why we managed to do all those things, all the volumes, to manage all the information that passes through, because we have that tech infrastructure in place. So it helps all of us, everyone who has interest in SEIS investing. That again, as I said, is pretty complex, but we dealt with complexities because we understood them and we put in place an infrastructure to deal with it.
Yes, and of course, there's no hiding place for us either, because Stephen, you invest in every single one of the funds that we do as well. And I know, Joseph, Angelika, you invest in many of them too. So it keeps us on our toes, keeps us young. I'm going to use this as a moment to pivot to the future. And rather than talking about the challenges that come with our proprietary technology platforms, I want to talk about the challenges that face SFC over the next few years. So this is a question to everybody, but perhaps we could start with Stephen.
For me, I'm looking forward to doing another podcast in about 3 or 4 years' time, and it's the podcast for 1,000 startups. Going back about 5-6 years ago, when we looked at renaming SFC as what was called Startup Funding Club, and of course we went through a deep analysis and came up with SFC, which you'd sort of think, oops, that wouldn't have taken very long. But actually we looked at a company called 500 Startups, an American company. And at the time we thought, my God, there's no way that we could do something like that, have 500 startups. But here we are, just a few years later, and we've got 500 startups. I can see that we will be very clearly 1,000 in, I can't say exactly how many years, but let's say 3 or 4. And as long as SEIS remains, as I said earlier, remains a government initiative, and they don't dabble with it, then I'm absolutely convinced and confident that we will continue to be the market leader in the SEIS world, and that we will find a lot more very exciting startups that will go on and become very successful potential unicorns. So at the moment, I'm not seeing a barrier to that unless it's some infrastructure barrier.
That's interesting. And you actually hit on an interesting point, which is that it was only a few years ago that we weren't anywhere near 500 startups. Yes. I always think of SFC as a kind of a game of two halves. There's SFC pre-2020, and there's SFC post-2020 when we really started to scale. Mm-hmm. Joseph, perhaps you could talk about that, but also add in your thoughts on the challenges ahead for us.
Yeah, I mean, obviously the challenge we have is the size of the portfolio. Obviously creates challenges in itself because you have to manage a large number of investments, a large number of companies. So the technology that we built helps a lot. We also need to obviously it's extremely time consuming. Everyone's working very hard. You need to, you cannot be a passive investor in most cases. So when you invest at that stage, you've got to find ways to help the companies to be first aware that there are issues and then find ways to help with those issues. So we do that. We need to, obviously, we've grown the team of the year. So it started, Steve initially, Angelika, and then me, and now we've got a team of 15 growing every year. So that will keep growing, and obviously we need to invest more in that sort of portfolio management function. So we're very much aware of that. And I would say the other challenge is, the challenge that everyone in the industry has, which is, generating returns on a consistent basis. We need exits. We need more exits. So that's why it's so important we develop this secondary market we were talking about earlier. If not quite a market, secondary opportunities and opportunities to returns in the best performing companies. I think that the whole ecosystem will develop, a lot faster in the UK if we can crack that, if we can have more liquidity, between different stages of investors. And that's starting to happen. I think we've done a good job with that. I think we need to really double down on that, so that, SES is not just a tax relief, it's actually a great investment.
Absolutely.
For
that's actually, without wanting to toot our horn too much, that's also another area where we're the market leader, is it not, with the number of exits that we've delivered back to investors. I said before how we probably invested in maybe 100 companies up to 2020 and then another 400 companies since then. Yep. So the portfolio is still relatively immature, and our track record, I know, says that we start delivering exits back to investors from about year 4 onwards, but really you're looking kind of year 5, 6 before you start to see more emerge.
Liquidity strategy is incorporated in our general strategy. So there is thought and focus on finding opportunities actively. And just to add to what my colleague said, I'm very confident about things that we can control and that we manage ourselves. We have a good track record with that, and we can grow and we can manage volumes and the growing number of companies. That's not an issue. I think the challenges are things that are outside of our control, which is the status of SEIS, which we hope will not change and will only improve. And in terms of liquidity, there is that much that we can do. We are always out looking for opportunities to sell and bring returns and return the money to investors, but then multiply it. But it's the market that dictates what is possible and what not, and the entrepreneurs, how they manage the situation. So there are those things that we have very limited impact on, but we are maximizing what we can. So we'll be trying to explore that and I guess get better as much as we can. We'll see.
Yes, absolutely we will. And I guess with SEIS, we've been the leader for some time now in the market. We, as you said, we do about 20 million a year, which is about 10% of the overall SEIS market. A few years ago, we also started our All-Star EIS follow-on fund, which picks out the top performing companies from our portfolio to reinvest in. Joseph, do you see this as a kind of key growth area for us over the next few years?
Yeah, absolutely. I mean, we are, this EIS fund, this follow-on fund, this all-star fund, as we call it, is becoming a bit of a headache, a good type of headache, because we've got a lot of companies doing quite well and raising new rounds, and picking the ones that we want to reinvest in is quite, we've got quite a lot of healthy discussions and debates within the team as to how we pick those. There's obviously those that they're the obvious winners, the companies that are raising their large Series A, Series B and beyond. And we want to be in some of those rounds, of course. But sometimes actually it's even more exciting to pick the company that you as an insider know is on track to be the next winner, but it's not maybe quite obvious to the rest of the market yet, but you have that insider advantage from the SEIS investment. So whenever we do a portfolio for that EIS fund, that follow-on fund, we try and mix those two type of companies. So the obvious winners, as I call them, so the ones doing quite well, raising from top name VCs, also to invest in that company that has raised maybe their SEIS round 6 months, a year ago, and is really picking up. And we're seeing all the signs that we've seen in the Cognizants, the Onfidos before, etc. And we reinvest before anyone else. And obviously we get more upside on those investments than the one that's raising their Series A or Series B. That's
one of the great things about this follow-on fund, isn't it? We get to look under the hood over a long period of time and get to know these businesses in a way in which a new fund coming in for the first time just wouldn't be able to. We learn the good, the bad and the ugly from it. And it also allows us to take advantage of our preemption rights, which means that we get access to some of these best available opportunities that other EIS funds might struggle to. I know that following on in our best investments is something that's really important and a good way to get good returns to your investors. Stephen, is there anything that you've been looking at more recently that is focused on how we can capture more of that growth opportunity from our existing portfolio?
It's a big asset of SFC to have these preemption rights in 500 companies that we have, and the fact that we monitor quarterly these companies gives us that deep insight into which ones, as Joseph and Angelika have mentioned, which ones that we can pick off for our future investment. So this is pretty unique to have that insight. Yeah. And they tend to, the good ones, the good companies who have good corporate governance and good reporting are the ones that we look for. And those typically are the ones that will report to us every 3 months, despite the fact that it may be a pain for them. And even today, Cognizant, which is one of the most successful ones we've talked about, doing multiple tens of millions revenue, still report to us quarterly. That's great corporate governance and great behavior by the directors there, because they're keeping their investors in the know on what's going on. And that's one of the attributes we look for.
Yes, so lots of opportunities for growth in the EIS fund side of things as well. Then it's interesting because IFAs, so financial advisors who I deal with quite a lot, are more used to the idea of EIS than SEIS, because SEIS is a bit more of a new product. But it's been a bit of a reverse for us because we're more known for SEIS, and when these rule changes came in, which allowed us to invest in more mature companies, so changed the risk profile, but also allowed investors to invest more each year, which made it worthwhile for these ultra high net worths. They came to us for the first time, really making SEIS an important part of their toolkit. And then they've learned about our EIS fund through our SEIS fund's work. So I think ideally what we want to be seen is a one-stop shop to do your tax-efficient investing. But we have been leading through the SEIS fund and hope to do more with the EIS fund as well going forward. So just as we move towards the end of this, are there any key milestones that you feel we still have to hit? Let's cast our minds forward to 5 years' time. Stephen, you said we want 1,000 in 3 years.
startups.
So what are we saying in 5 years?
Well, 5 years. It's going to be back to our investors getting a great return, to be honest. How will we be ultimately measured? It's not on 1,000 startups or 500 or 2,000. It is on investors having received a good return from their investment. And that's how we should be judged. And that's where the secondaries and the exits strategy and the liquidity strategy comes into play, because that is fundamental to our future success. And it's something that we are absolutely working on, and we are looking all the time for ways in which we can get money back to the investors and profits to the investors. And that's how we will be judged.
Yeah. I mean, in terms of milestones, I'm still surprised how the awareness around SEIS and EIS is actually quite low when you speak to people who could be investing under those schemes, who could benefit from them, just not aware of them. So I think there's a huge growth opportunity for the SEIS, EIS world in general, and therefore for us as well. So we've got more than 2,000 investors in our funds right now. And I think realistically over the next few years, I think we can hit the 10,000 mark. It's actually a very realistic goal. When you look at the overall potential size of the market, we can make this startup investing market in the UK much bigger than it is right now. There is that potential, absolutely.
Absolutely. It's catapulted startup investing, but it's only scratching a tiny portion of what's possible. So to give some figures, there were 9,500 SEIS investors last year. There were 40,000 EIS investors. They contributed over £2.5 billion together, and 200 million of which was done through SEIS. Now that's out of a market of over 2 million people in the UK who are classified as high net worth by earning over £100,000. So if we combine them, you're looking at about 45,000 total investors out of a market of 2 million. That is a tiny fraction of what's possible. So I think you're absolutely right. As the next few years go on, we really want to increase awareness for SEIS and EIS. Angelika, so it's been more than 10 years now, and we've achieved lots of things that we've discussed already. What would you say you're most proud of about SFC right now?
I would say the team, because that's the team that makes things happen. And all the investments, obviously, the most important are the best investments that we've made. But it wouldn't be possible without people that are working on it. And I was amazed that we managed to attract talent, and that skilled, motivated people were coming to us asking for opportunities and staying very long time. The core of the team has been for years in the company, and new people come and they say, can I work with you? And we love that, because these are people that are self-starters, that are very entrepreneurial, and that make this company very entrepreneurial, not corporate, not typical VC, but people that understand what it takes to succeed. So definitely we have fantastic investments. Hopefully will turn into proper returns to investors. But the team behind, that's what makes it happen. And that's what I'm probably the most proud of. And I was involved in employing each one. So
Brilliant. Well, I think that's a very good way to end things. Thank you very much for listening. Thank you to Stephen, to Joseph, and Angelika. I've been Ed Pryor. This has been SFC Capital. You'll find our next episode in this series available in the coming days. Thanks for listening.